Okay, welcome back to the Trend Following Trading Club on Twitter Spaces. Every Friday morning, 8 a.m. Eastern Time. Well, not everyone, but almost. And I even did it when I was in Portland, 3 hours, 5 a.m. So we have a big commitment here to make it happen every morning, every Friday. We have a lot of faithful listeners. And we have some things to talk about today, and hopefully some new things will pop up. Um, Let's see here. What did I propose? Oh, French fries. Yep. We found a French fry company we can all invest in. I think that's a pretty good idea. Sample size, and there was a third thing that I forgot about. Anyways, Oleg, what have you learned this week? You do a lot of summarizing of TTU podcast. What stood out to you recently?
Hi to everyone. Every time we meet, I say the same things, that I'm very happy to be here because it's really so. So I'm saying this in this time also. I'm very happy, and I'm waiting all the week, and when this recording will be ended, I will start to wait another trend following trading club meeting.
Morning, Niels. What's going on, Niels?
Good morning, Jared. Good morning, everyone. Yeah, not every week is possible for me to join, but when I can, I will. And as you say, it's always good to spend some time talking trend following with this loyal group. And no, other than that, I saw the topics you posted. Excited about it. Excited about to hear what Rich has to say about it and to see what comes up during our conversation.
Just wanted to say good day. You're right, Jerry. It is 10 p.m. Hi, Niels. Hope all is well.
Absolutely, Rich. And yeah, looking forward, as I said, to hear some of your thoughts. As always, very eloquently put. And I thoroughly enjoyed some of the stuff that you and I talked about last week as well. I think it corresponds to some of the topics Jerry put up. So yeah, let's dig into it.
Oh, I remember now what the other topic was, and it was Cliff Asness wrote um, a piece this week, and I always like to read Cliff's stuff. He's very smart and very accomplished, very funny. And this piece wasn't funny, and it talked about how Managed Futures has gone off the track of, I think in his something like mostly he would prefer it had some more crisis alpha capabilities. And also, the second part, I think, of the article was something along the lines of trend following information other than price only, I think. And I think we had sort of discovered that was an element to what they do. And I believe he was kind of criticizing more negative skew carry type strategies. And although I don't really agree with any of that, actually, I just feel like my big complaint with managed futures is that it's more not trend following, it's just managed futures. It's a bit of trend following. It's different from every firm, and then plus other stuff um, doesn't let profits run. And yeah, that, I'm sure they all take small losses, but doesn't let profits run. And so it's really not trend following, or even obviously classic trend following. And so as over the years, I've rejected, like, let's stop calling it managed futures. Let's call it CTAs, diversified trend following. But now I've changed, and I think, oh yeah, let's definitely call it managed futures, because then we can just call trend following, and the two are not the same. And so Cliff, though, is more into this idea that managed futures should be crisis alpha, and they have kind of blown that. Although I think this year they've tended to do pretty well, and classic and non-classic managed futures has done pretty well, pretty well too. So I thought that was a pretty interesting article. And then I coined this term. I mean, I coined it. I don't know if I did or not. Mismanaged futures. So that's kind of a rude thing to say, but yeah, I guess I'm going to stick with that mismanaged futures for a while. But for me, it all just revolves around the lack of the industry doesn't really do as much hardcore classic trend following as they used to.
And you did get a coffee spill from that, Jerry. I did spill my coffee when you did the mismanaged futures. Go for it, Niels.
You know, I was just going to say what's interesting about the article, I just finished reading it, is that our suspicion and what we've been discussing is that we feel that the industry may have becoming more focused on, in lack of a better word, vol targeting, in terms of the changes that's been made since the great financial crisis. But what Cliff is suggesting is that he thinks that the industry has got carried away, as he puts it, quite funnily, meaning that he believes it's not so much vol targeting, but the fact that the industry has added carry trading strategies, and that's what's really sort of causing this difference between pure trend performance and the industry. So I thought that's an interesting observation. I don't know which one it is. Maybe it's a combination, but I thought it was an interesting difference to how we've been talking about it.
Oh yeah, and I really enjoyed the podcast with Niels and Richard earlier this week, and I agree with you, Niels. That the only thing I've been very busy, so I've only listened to it once or twice. I usually go for like 5 or 10 listens, and I haven't had much time this week. But I definitely agree with Niels, probably for a different reason, that I no longer really want to call it vol targeting. Niels, I like the term you came up with, which is dynamic position sizing, although it is a little mysterious, like what does that actually mean? So I kind of usually say volatility management, because once I got into thinking about it and reading more and listening more, it was far more than volatility targeting. It's universal, and it's way more than just resizing the position based upon increased volatility. You got correlation in there, volatility, and so I think volatility management, that's what I've gone to recently. It's kind of a more accurate term, but I think dynamic rebalancing, very, very good as well.
Yeah, I mean that's actually what I meant when I say dynamic position sizing. It is to capture the correlation side of things because, as you say, it's actually not just volatility that plays a role here. So that's exactly why. So yeah, I agree on that.
By the way, I also was impressed by this dynamic position sizing. So it was appreciated by me because it shows us something maybe something that maybe new when we hear dynamic position sizing. We can think about some new things about vol targeting. Anyway, if for me the best way and the way I have chosen is trend following trading, classical trend following trading. So,
hi everyone. Hey Jerry, hey Niels, hey Oleg, hey Richard. So I mean, this week I was just thinking about what you just discussed in terms of the volatility price, where the usually the trend following is going, but also recently, of course, there is a new dimension into what we're trying to do, which is the speed component. Now we all have the other dimensions like the price, the correlations, the volatility, but every day the importance of using speed in this classic trend following area is increasing. And when you're talking about dynamic position sizing, I think things that were not necessarily possible in the past are possible today because the speed is much more easier to access, and it is getting mainstream. And I believe when Neil said how this industry is going to evolve over time, if I'm able to use speed in my trading, this means that pretty much anyone a little bit of a code can use speed in the component of speed in their trading. So I think the point that I'm trying to make is, as we move along from here over the coming years, how we approach the speed element will be very important going forward. I'm not quite sure whether am I able to explain it though. Thank you.
Well, yeah. I was just going to ask what you meant by it, because when I look at all the data that I see very little evidence that faster strategies are as consistent as slower strategies in the long term. So, for me at least, if we stay with sort of traditional trend following, I actually don't think speed is that important. And the look back periods that you typically find to be working most consistently over time are somewhat in a relatively narrow band, but they're longer term. They're not shorter term time frames. So I wasn't entirely sure what you meant by speed becoming important or more important.
I mean, it is, obviously, you're working in the down capital line, it's a big, industry giant, and, these guys have started in 1970s, which we are all trying to learn from and aspire to as new traders. So it is there. But, what I'm trying to say with the speed is, now there are lots of ways which, with a little bit of coding, you can incorporate, like I do, like you can trade hourly bars into your classical trend following bucket. So you can continue to trade 100 plus days. On the long term, you can do your medium term is probably more Aspect Capital is famous of with their medium term strategies. And then, you can also incorporate hourly bars. And how are you going to trade hourly bars or even minute bars? How are you going to do that? The only way that you can try to do it is with the help of speed news, and this means that you gotta code the strategy so that you will be able to trade with that. Um, and the point that I'm trying to make is it is getting more and more accessible. So you don't have to be a major big hedge fund to be able to use speed in your day-to-day trading. And with the Python being much more mainstream, I think if this trend continues, you will see that more new traders will continue to use this in their day-to-day trading, if I'm making sense.
Okay, yeah. Okay, no, that makes perfect sense. And so my observation of that would be, so yes, you can certainly add to your longer term strategies. You can add shorter term strategies. The question for me becomes, well, are these shorter term strategies somewhat different? In order to work on an hourly bar rather than, a daily bar, and in order to work on a short time frame compared to a longer time frame, are you then really adding new strategies rather than trend following? Meaning, are you doing something slightly different? Um, which I suspect one would have to, and then it starts getting away from what I look at as classical trend following. The other thing I would just mention is, and by the way, obviously it's also personal preference, of course, is that if the bigger firms like Chesapeake, like Dunn, if we can do it slowly, so should smaller traders. Meaning we don't have an advantage or as such, right? Well, the only advantage we may have, of course, you could say, is that we have experience. We have a team of people to test more ideas and to implement, etc., etc. Um, and we can trade more markets. But if you were a quote unquote individual trader and you had enough capital to trade a diversified portfolio, I actually don't think you have any or I actually don't think that Jerry or Don has an advantage per se. And so it's I tend to find that a lot of individual wants to have this fast speed because they want to trade. They're traders. And I know we talk about trend following traders, but I actually see the the real trend following industry more as investors. We're not short-term traders. We are trend following investors, if I can put it that way, even though it sounds crazy when I say it. But that's how I see it. I think this urge to trade is not necessarily beneficial. And I don't see any evidence of short-term trend followers having been successful. So I wouldn't suspect that smaller accounts trying to do that would be as successful as a longer term trend following strategy.
So okay. So I've started this year, so you can keep an eye on me how I am doing over the years. So this is a very positive year for me as a short-term trader. But as a short-term classic trend follower, so I'm pretty much doing everything else that Richard Brennan and Jerry Parker is doing, just with the only exception of trading hourly bars. Other than that, everything else is the same: one entry, one exit, one stop, same very similar quantity calculations, etc., etc. But the point actually that I'm trying to make is the things that were not imaginable in 1970s and 80s are now possible now and going forward because of so the technology first enables you to use speed, number one, so you can actually trade hourly bars with your investment hat on. So the fact that you're taking thousands of trades per year doesn't make you short term. It just gives you an edge to use a less correlated trend strategy in your mainstream portfolio. So of course you're going to continue to trade long term and medium term, but you will just incorporate short term there. So you will be better diversified. You will be diversified with a time frame as well. So that's one thing. And of course, the second point is, if the technology goes so well that are you going to just keep trading a trend model? Why not trade 30 models altogether? The things that were not humanly possible in the past will also become very, very much possible as you go along and you wanted to leverage the technology. I'm not saying that I'm in that bucket. I'm a trend trading person, but I think it is the technology, the speed is making things available to experiment for not only new traders but also established quant funds going forward. And I see that the majority of the industry is going to be quant in one shape or form going forward. But I might be wrong. I might be totally missing the point. But just wanted to share. Thank you.
No, I just want to say that I don't disagree with that. Of course, technology allows us to trade at much higher frequency if we want to. So I don't disagree with that. And I also don't disagree with, of course, you can develop shorter term strategies that are highly profitable. For sure, that's not impossible at all. But there are not, what I'm trying to say is that I see more evidence of the longer term timeframes working for extended period of time. I don't see, I mean, you could be the exception, of course, but I don't see many firms in our industry that are shorter term that have survived for 2, 3, 4 decades. That was my point. So, but yeah, I mean,
Yes,
great to hear.
yeah, but I'm a new trader. I've just started new. Just look, this technology
Repeat that, please.
wasn't available a decade ago.
I was a short-term trader for, I said that before for many times. I was a short-term trader for many years, and I stopped being a short-term trader because I have discovered top traders and blocked, and I understood that it's not the best idea, for me personally at least. I'm talking about myself. And I want to say that I had a lot of research in short-term space, and I'm sure that if you are trading in a short-term space, you must need to have filters. Because it's too much noise, very, very, very noisy environment. So to have some filters, I don't came to a 100% conclusion that it's the perfect decision. I don't know it, but as I have seen that if you have filters for entering the trades, their performance get better and drawdowns also get less. It's one of my points here. But in the end of the day, I decided to be a long-term trader, like Niels do, like Jerry do, like Maritz do.
Oh, Rich, you were I enjoyed the question from Antonio. Did you have anything you wanted to add to Antonio? I know I do. And did you want to summarize Antonio's question? I was thinking about this and sample size and trend following and sample size, and I had some thoughts, but I was preferring you go first if you wanted to say more or clarify what you said on TTU.
Yeah, so Antonio was talking about sample size. The critique that's saying that, you know, we're targeting these outliers. These outliers are anomalies, few and far between, and who's suggesting that surely we should be using a small sample size method as opposed to a large sample size method, because these features that we're targeting are never repeated. They're unique. They can't rely on a sample size. And so that's where the discussion at TTU with a podcast with Niels came in referring to extracting information from the market data. So what I was referring to was that you know, a lot of people talk in terms of probability when they're targeting a particular edge, but really what they are doing is they're looking at the information in that sample size that validates their model. And if they've got a lot of information that validates their model, that therefore comes with a high probability assessment or a high probability weighting. But really, it's the information in that data. So when we therefore look at what a small sample size means in terms of information, you can see that as you reduce the sample size, you're getting less and less information in that data sample. And because the noise of an efficient market is embedded throughout a time series, as you're getting less and less information, you're also getting an increase in the relative noise to that information. And there's a term that we all use when we talk about a signal, and really a signal is related to the information that we are targeting in that market data. So, I think Antonio might have been confused with the term, you know, data versus information. So just to explain that, when we talk about data, we're talking about individual facts or factoids that exist in the market data. But when we're talking about information, information relates to how we assemble that data into a context. And so when we're talking about extracting information for our trend following models, we're after particular information that supports our models, particularly in relation to, is there an outlier in that data? You know, that's the sort of information we're extracting. But another type of trader, such as a mean reverter, is after different information. So this is where you have this symptom arising where one person's information is another trader's noise. In other words, context is incredibly important, and the context relates to the systems or the models that you're trading, and the information that you are deriving from that market data is different for different contexts. And that's where, when you come to a small data sample, you see that the level of information in that is limited. So for trend followers, the way we get around this problem of the limited information associated with outliers is that we are not trading a single market. We're trading a diversified portfolio of hundreds of return streams. And, you know, when, for instance, we've got you, Jerry, you've got 200 markets, you've got 4 models. So that's 4 times 200 markets times maybe each return stream might have 3 outliers. So you start seeing at the portfolio level how you get a vastly much bigger information set. And that therefore validates our premise of outliers. So we can't obtain that sufficient information from a single market. Therefore, we need a diversified portfolio to achieve that. And that's how we basically get sufficient sample size to validate our entire process. And that therefore results in a method that gives us a positive expectancy, because there is sufficient information in that diversified portfolio, provided we trade the same way across every single market, to validate our premise. So it was just I was talking with Niels at the podcast about that's what we mean when we're talking of a large sample. It's something that, you know, we need to extremely or extensively diversify our models to get sufficient information from the outliers, but more importantly, the information that, you know, because each of the individual outliers is unique in character, we're actually not getting specific information that supports our ability to target those outliers. And that's why we need a loose pants model to target them. In other words, we have a design statement with our systems that allows for unlimited profit potential. That's all we need to get the sufficient information to justify the outlier component of our method. But the large sample size for us is critical for risk management purposes, because at the time we enter a trend, if you could imagine, if you have that visual diagram of the market distribution of returns, the time that we enter a trade or a material trend typically is not when it is chaotic. It's about to get chaotic. But at that point of entry, there is a lot of information we can obtain from the distribution that is non-chaotic in nature, such as how small is our bet size? How far away should our stops be? How far away should our trailing stops be? We can, at the point of entry, obtain that information. But once we've made that bet and the trend goes into this regime of chaos, that's where the information ends. So we need a very loose pants model that has unlimited upside potential to extract whatever the market delivers from that. So that was in a nutshell what I was talking about with Niels.
Yeah. I was thinking of something else that you said, and that is that on these outliers, we don't have great information as to how to handle them. You know, we've got them, we're in there. They're 5 to 10% of our trades. So, and then you've also mentioned that's your complaint with vol management, and that is there's no added information here. You know, I have sort of thrown out there after listening and reading about the virtues of vol management, and I think to some degree, it's almost like, are you saying that vol management, as far as entry and exit, is better than the breakouts? That doesn't sound right. Are you also saying that vol managing, which smooths things out, can also make more money? I mean, this is the greatest revelation of all time. We can smooth it out, we can sacrifice, but there's no sacrifice. Yeah. So, anyways, I'm getting off track, but I think
but exactly, you know, that's the discussion Niels and I had, because it's very interesting. So what I'm saying is that my philosophy says that I'm only interested in the chaotic region of the distribution. And I'd say that, Jerry, you are as well. And in that region, it's information deficient. And therefore, what volatility doesn't give us any guidance as to a method to deploy to give us any additional edge in that region of chaos. And this is where context is so important, because I think those that apply dynamic position sizing are actually extracting an edge not from that chaotic region. They're extracting an edge from what I refer to as more the bulk of the distribution of returns, where there is information. So, of course, and this is referring to, we talk about splitting up our trades into 10% that mean something and 90% that don't. Now, what I'm saying is that those that apply dynamic position sizing, are actually getting a benefit from that 90% that we're not getting, because they're getting this information about volatility that is allowing them to smooth their equity curves. It's drawing on the bulk of the distribution. It's not targeting the limited information in those tail regions. So now, therefore, the debate comes to, well, what regime do we work better in versus those that deploy dynamic position size? And I'd say, well, we work well in a chaotic regime where things, there is limited information. However, we might not necessarily beat those other methods that are adopting a blend of chaos. So they are getting some benefit from the tail region, but they're sacrificing a bit of that benefit for targeting the edge that resides in the bulk of the distribution. So if you can imagine in terms of capital efficiency, we are investing 100% of our efforts in chaos. They are investing perhaps 50% of their efforts in chaos and 50% of their efforts in the edge that resides in that bulk of distributions. And so they're getting a blend. Now, the argument therefore is which is better? And of course, there is no tick box here. Both methods are applicable. However, what I'm saying is that if you accept that the future is unpredictable, which I do, and if you accept that we could get vastly more extreme chaotic regimes than we've ever experienced in the past, I would always prefer to adopt my method of strictly focusing on chaos, because we've already demonstrated that we can get significant alpha from that over 200, 300 years or whatever of classic trend following. However, what I'm saying is that those more advanced methods, more sophisticated methods that are using quant processes to basically get information from the bulk of the distribution to sort of give them an enhanced blend, they might not necessarily perform really well if things get incredibly chaotic down the path in the future. So that's where I'm seeing sort of where the two paths sort of are targeting slightly different regimes, and that's what I'm thinking.
And he also made these comments, which I think are very interesting, about trend following demands a large sample size. And there's we've mentioned many articles out there, and they're written by very smart people who talk about this. And then not only that, but because it has a non-normal distribution, it demands even a larger sample size. And then so he sets it up like that. Then he says, but wait a second, if trend following makes money off of these chaotic situations, these rare events, and it's only around 5% of the trades, then shouldn't we target those 5% and try to find a system that has a small sample size, i.e. the sample size of that 5%? And I thought, yeah, that's pretty interesting. I mean, it's not correct, but I do think another way to criticize trend following and this strategy of, so you build this sample size. Let's start from the beginning. You build this sample size because you're trading all of these markets. You're doing this back test on as many markets as you can get, currencies, commodities, stocks, bonds, and longs and shorts. And you're trading them all, the longs and the shorts, and all the markets with the same system and the parameters. And so then you run this back test and you have these trades. Classic says trades. Managed Futures says look at some sort of period return. But we look at our trades and we say, okay, we have thousands of trades over 30 or 40 years, and there's our back test. And then someone says, well, wait a second. Almost all of those trades don't do anything. 90% of them break even, and you have 10% or even less that make all of the money. And you think that you can you can say that you have a large sample size because you've created the rules of the sample size are based upon I treated everything the same. But I'm saying not so fast. You only have a small sample size because the only trades that really matter are those 10%. And so I think it's a unique way of critiquing this strategy, and a strategy like this with these type of distributions, although people much smarter than me have said it's not accurate. But I think that's kind of where he was going, is it's kind of like we have this net, we put it in the water, we catch the biggest fish, but 90% of our fish are very small, And somehow, why can't we just make the day a lot shorter and figure out a way to only catch the large fish? See, this analogy is breaking down, but I think it's a little fascinating to be able to, like, I've called it like tricking the numbers. Um, you have these thousands of trades, and then you sort of say, oh yeah, only 10% of them really matter. I didn't really even notice that. And so you can claim you have this sample size. At the same time, 90% of those are really not making much of a difference. What do you think?
The way I'm viewing it is that, with our models, they're very simple models, very robust models. They've got a single entry, a single exit or a trail, and then they're open profit. So what is the information we need from the sample size for that type of model? We don't need any information for the profit side of it because we don't have a profit target. These outliers, these anomalies, they can do anything. Price can do anything. So provided we simply have a statement in our models, an unconstrained statement that allows price to do whatever it likes within a degree of freedom, that is sufficient. But we do need information for how short a critical thing about trend following is to avoid overtrading. I think we can all agree with that. So how do you avoid overtrading? You need sample size to avoid overtrading, because if you treat all the markets the same way, that means you are not focusing on a particular character of an individual market. You're looking at a solution that is applicable across all your markets. So that's where sample size does come in, because how short do we cut our losses? When do we exit? We need information for those decisions, and that information has to be drawn from information that is available in that market data. So when we're applying the same model, and the reason we're adopting the same model is we're using an ATR-based model that normalizes to any particular market, and therefore we can treat each market as just an alternate history. And therefore, when we apply our very simple models, we are demanding large sample size to know how short and when do we exit. These are all risk management decisions. They are not the profit decision. The profit decision, we've got no idea where those profits are going to go, and potentially they could be unlimited in nature. But that's exactly what we want. We're focusing on the risk side to cut those losses short, prevent overtrading, because when you overtrade a trend following strategy, that blows your whole situation up. You want to avoid participating in market events that are not material in nature. And therefore you want to avoid the whipsaws that are accompanied with the bulk of the distribution of returns. Much of it is noisy, much of it is mean reverting in nature. You therefore want a model that says, and also, when do you participate in the trend? That comes from sample size. So we talked before, or Trader Mentor talked before, about short-term models. What I'm saying is that provided we understand that we are at that verge of chaos where things get chaotic, when that occurs, you can employ an ensemble of different trend following systems, some fairly short term in nature, some medium term in nature, some long term in nature. But it's not, we're not doing that at all points of the distribution. We're only doing that when things start getting chaotic. And that ensemble helps us basically get as much of the juice out of those outliers as we possibly can. That's sort of what I'm saying.
I totally agree, Richard. Yeah, 100%. Yeah, excellent comment. Actually, thank you.
I was on mute, and I've said many times that the when we exit, we're not saying that the trend is over. Obviously, I'm not saying it because I have three more systems, and they're all still long. And so it really isn't so much that it's not very profitable to look at the chart and say, oh, that trend is over, that trend is anything, it's something, or that trade is over, because so often, as soon as I get out of all four systems, it goes right back to the highs. So this information that we're lacking when we exit, especially in chaotic times when the trends have been really large, is obvious. um, it only works because we're systematic and we follow these rules every single time, and it works overall because we use this disciplined approach and we kind of get our fair share of good stuff along with the bad stuff. Where I think if we were more discretionary and more or use discretionary tactics, even though we could call them rules, will show that we won't do quite as well. And then another thing that happens sometimes is that like like now I didn't do very well, let's say in 5 or 6 commodities. I gave back a lot of profit, but I never got out of my natural gas. I mean, just look at that chart. What is going on? It went, a lot higher. It crashed, and then it went right back to the highs. It is tremendous drawdown, this tremendous open profit that was all went away. And so what I'm saying is the numbers, this happens in the back test. You make more money with this particular loose pants exit, but you'll come across periods where you'll kind of mishandle or give back a lot of profit on 5 to 10 trades and make it all back in natural gas. If not, the computer would not recommend loose pants or this particular exit strategy. So that is pretty darn hard to bear in the moment.
As I remember, Mark Jabrzynski said, I don't remember what he said exactly, but as I remember, he said that it's always a surprise for us when the trend is over, and I think that it's always a surprise for us when trend started. Yes, discretionary global macro guys do a lot of suggestions, a lot of predictions, a lot of different things. But in the end of the day, when the trend starts and when the trend is over, it's a surprise for them.
Yeah, I think we've got to get away from the concept that our systems are the things that are capturing trend. They're not. Our systems are the methods that we extract the trend from the market. And when you're looking at these major price moves visually in the market data, not what our systems are doing, but in the market data, you see that the visual form of these trends in these high sort of major price trend moves, they're visually all incredibly different. And this is representative of the fact that what we might think is a trend. Everyone has their own definition of what a trend is. And, you go back to Charles Dow and you see that he was prescriptively identifying a trend as it must touch, 2 or 3 highs, it must touch low, 2 or 3 lows to basically be able to draw a trend line. We're saying, no, that's not the case. Trends can take a huge different array of different forms. You will never be able to predict what form it's going to take, but you will apply a system as a means to extract the edge that you can from that trend. So, our systems might be exiting a trade, but that does not mean the trend is over. The trend can do anything. The market decides what the trend is going to do. Our systems are the containers or the methods, the constraint devices that we are extracting aspects of that trend by our systems. So with Jerry applying 4 systems, he will find that he can never predict which of those systems is going to extract more money out of the trend when he is trading those major outliers. And he'll probably find that at the end of the back test or at the end of his live trading experience, he'll find that on the balance of probabilities, they're probably pretty well equal in their ability to extract trend from that market data. I find that with my systems that I deploy, an ensemble of different systems, I find that you can never predict which one's going to work, and that's why you apply an ensemble. An ensemble is another means of producing extra loose pants to extracting edges from these price moves that are chaotic in nature. We don't know what they're going to do, but we have very loose pants and an ensemble of different systems that capture, a lot of different possible trajectories that price might take. And that's what's how we are extracting this edge using these asymmetrical models that are open-ended in nature, have constraints in place that preserve our capital, have constraints in place that prevent any downside. We don't want to go to the left tail of our trade distribution. We want to all focus towards positive skew of the right tail. But when we're trading these markets, long or short, we need these constraint devices to mitigate that risk and allow for this unlimited upside potential.
And Richard, when you're talking about this unlimited upside potential of outliers, especially outliers, so we all agree that we make money from outliers on the trend following space, especially on the classic trend following space. But is it possible to break it down into various components, such as trend signal? So how much of this trend following profit it can be attributable to the signal, to the portfolio selection, and to position sizing algorithm? Because in my mind, the signal is a system, then the quantity calculations is an overlay of system, then the portfolio selection is an overlay of system. Actually, there are three things that are working with itself to be able to come up with those outliers. And I wonder, is it possible to break down that profit from outliers to these different components of a system?
Yeah, so this is where, unfortunately, I don't think we can get quantitative about it, because what we're really doing, and the reason these major price moves are so different to what the normal distribution is getting, is that these major price moves have this feature called serial correlation in them. And there's this big positive serial correlation, not negative serial correlation. That's what mean reverters are targeting. And it's not, no correlation. That's what a normal distribution produces. We're after positive serial correlation. And what that means is that price amplifies. Now, this is where the distribution becomes non-normal. If it becomes dependent on prior price data, as opposed to independent prior price data, which a normal or a random distribution produces, if it is dependent on the price data, it gets positive serial correlation, which amplifies. And when things amplify, you suddenly find you don't have a single mean to work with. You don't have a median to work with. You don't have a standard deviation to work with. That is information that can only be created through a normal distribution where price is independent. When it amplifies, you lose that information. So there's very little quantitative information we can derive to assist our models or make our models more complex. We've therefore got to go the other way, go to more simple models, giving more freedom for movement, because we can't, this is information deficient. We can't get any information to help us. But at the portfolio level, we don't, for instance, apply strictly correlations. A lot of the classic ones don't apply correlations as strictly as other methods. And so if you can imagine, when a portfolio uses correlation as a basis to manage risk, they're basically shuffling risk around the portfolio through different weighted positions or different weighted return streams. Some return streams with dynamic position sizes have a high weighting. Some return streams have a low weighting of risk. This is what I call shifting risk across the portfolio, using correlation as a guide to manage risk. But I know that in these chaotic regions where you can't draw on this information of correlations, where things start breaking down, we as a classic trend follower in the chaotic regime need equal weighted return streams. We can't afford to stuff around with different weights of our return streams. Therefore, the most simplistic thing we can do to achieve maximum diversification, because we need maximum diversification to hunt for these outliers, but we must do it in an equal weighted way. And that's saying that there is no quantitative information that helps us make a bigger risk bet at any point in time. We don't know what it's going to do, so they've got to be equal weighted risk bets across the portfolio. And that's all related to this information deficiency. So I know where you're coming from, Trading Mentor, but I don't think we can get too smart in this world of chaos. I think we've got to simplify and get looser, give more freedom, but we do need to protect our capital at all times.
Thank you.
And I like the idea of Richard. It's a very interesting idea that our sample size and our backtest, massive backtest, is very critical for the purpose of a risk management. So I think it's interesting.
Hi guys. This is very interesting actually because and together with Rich's and Neil's session uh, this past weekend, it's really fascinating stuff. Um, I hear exactly what you're saying, Richard. The only objection I might throw in there is that variable position sizing, which is really the new word for it. I think it's really what it is. And some people use historical volatility. In my opinion, it's a mistake. Some other people use a more quantitative and a richer structure for it. But I think what variable position sizing tries to do is reweight each position depending on what the market is doing. So, much in the same way as Wayne Helmsley was talking about in his podcast, in his YouTube last week, it's, it's about this, at the money straddle. And every time the market moves, or anytime you got open profits, you can monetize them and you can sort of, gamma hedge and restrike all the positions and extract that complexity premium as you go along. So that's really what it is. Obviously, and we said it before, this comes at the cost of lowering the outlier potential. So, if we look at outliers, classic trend following makes more money per outlier, but variable position sizing, and Niels was touching on it in the podcast, I think achieves a better per trade return. So I think that's the trade-off. That's what really one has to decide, because much in the same way as Jerry hates it, but there's no right and wrong in trying to size which part of which side of the equation you want to optimize for.
For me personally, it's very important that Jerry always says that we must take from the backtest at least as least as possible, because we must understand how our system handles the trend, how we can catch the trend, and how it handles stressful environments, drawdown environments. And first of all, we must understand this, and I fully agree with this.
Hey, everybody. I was curious if anybody had the data. If you incorporate volatility management or dynamic position sizing or whatever you want to call it into a trend following system, does it tend to increase or decrease the expectancy of the system?
I think here, maybe I'm wrong, of course, but I think here the past isn't a good guide, because we don't know what the future environments, what the future can bring us, and it will be, we can't even imagine what it will be. So I think here backtest is not very best guide. It's only my opinion.
Well, that's pretty good, because I'm kind of definitely in that camp as well. And Rob Rob wrote a paper on all of this, and so, but I really don't agree with the conclusion. I mean, I kind of agree with the conclusion, and I've been very consistent over many years. And that is, if I were to do it, I would do it a bit different than Rob. And of course, we have done it. And that is, I would start with my one entry, one exit, and a stop loss, and vol manage. And so if you vol manage and compare the one entry, one exit, and a stop loss to one entry, one exit, and a stop loss, and some sort of vol management. Now, the problem with doing these back tests is that everybody's going to use slightly different assumptions, and they could all matter. One of the assumptions that we would always use is we're not going to do this daily. It has to be like every 5% change or every 10% change. And it's simply that you make less money in that scenario, vol management, but the Sharpe ratio is higher. So you can leverage up and you have a better system. But you have to trade a bit larger. Like you risk 25 basis points versus on this, with no vol management, and maybe 35 basis points or 30 or 40. I don't know. I don't remember what it was, but obviously it stretches credibility to think, well, no, you're going to have no fall off in profit. Overall, some trades, they're going to work out better vol management. Niels talked about that at the last podcast. Overall, looking at all the trades over 40 years, thousands of trades, it's not going to make more money and have less risk if you're defining risk by volatility. Come on. Isn't it good enough that it just raises the Sharpe and you can trade larger? This is what traders do. You trade 20 markets versus 120. You can trade the 120. Your risk budget can be a little bit bigger because it's less volatility. You have more diversification, more outliers. So we understand that it's not a total free lunch, that it's good enough that it just produces a better risk-adjusted return if you view that in terms of vol and Sharpe. And then once again, you're getting back to this silliness, which is, oh no, it has this, the vol management is better than breakouts. No, come on. It's billed as risk mitigation, risk management, not enhanced trend following. If you get out of these trades and it has some sort of special ingredient that it tells you it's better than waiting for your system exit, the moving average crossover or the breakout, then you should just use that if it's so superior. So I think it's kind of laughable that there's not trade-offs. And at least that's the way that I would approach that. And I think Rob's final conclusion was that you can define vol management as better because it does have a higher Sharpe ratio and you can trade it larger and you can essentially make more money, all of which I agree with 100%. I just think, and I've said it for many, many years, and it's just that in some ways, you are transferring open trade equity risk, volatility, you're transferring it over to having to take larger losses. So that's my little tirade.
I totally agree with you, Jerry. And look, just something to keep in mind. All of those methods that are using the back test to derive their information are going to find that they fit to that back test. So we can always go back with a back test and get a better result using a back test. But the bottom line is that we're talking about managers with a long-term track record. They don't have the benefit of the back test. They're trading a live track record. And a lot of people can say, well, look at Man AHL's equity curve. It has a higher risk-adjusted performance than, say, Mulvaney does. But the bottom line is that Mulvaney, even though it's got a volatile equity curve, is pulling in the highest CAGR compared to Man AHL. Now, an argument would be, well, that's because Man AHL, if they chose to trade at higher leverage, they'd be able to outperform Mulvaney. But the bottom line is they haven't. They have set their risk management, they've set their volatility measures to produce this smoother return, and the result is they've got a lower CAGR at the end of the story from a live track record than, say, someone like Mulvaney. Now, Mulvaney does not apply dynamic position sizing. So Mulvaney just looks at the raw nature of outliers and capitalizes on that. So, the same way that we could say, well, when you look at a back test, you could produce a better risk-adjusted result with dynamic position sizing. We could say, well, if you present us with more and more outliers in our distribution, as opposed to what has been presented through that back test, we will be able to outperform you. And that's not using any form of strategy manipulation. Through using the back test as a guide. That's using simple loose pants systems that leave open-ended profit potential. So what we're saying is our method in an environment of chaos produces a really good result. We're not arguing that dynamic position sizing doesn't produce a great result. We're just saying it's reliant on back test. It's reliant on information derived from what history is presented. We're saying that is not the way to look at classic trend following. We have a process that allows us to deal with future uncertainty, not what the past has given, but future uncertainty. And that's why I'm a big believer in our philosophy. And I think the philosophy has got to stay front of mind as opposed to what the back test tells us.
And in terms of where this is coming from, why there is so much discussion between well managed or not well managed. I mean, am my understanding is right? Just because this well managed is mainly coming because the main investors are, family offices and pension funds, which are managed by people who needs to manage their career risk. So because they need to manage their career risk, it is easier to explain to the board of directors low volatility. So that's why there is a demand for that. So that's why, even though this well-managed trend following wasn't there 30 years ago, it exists today because who owns the capital to be able to invest into the hedge funds space have changed. Am I getting this right?
Yes, I think so. I think it's a desire to meet investor needs who are allocating AUM. This turns a trading strategy into a business case, as opposed to what we're suggesting is probably the correct way to treat it, is that there's the philosophy or there's the business. And we're saying stick with the philosophy, don't get caught up in a business.
But when you say investor risk, in my mind, these people are mainly managing their career risks. So these are not wealthy individuals like high net worth clients actually who are demanding this. But instead, the other managers sitting on those pension funds and family offices who manage money on behalf of these high net worth clients are actually making these calls.
Yeah, so the investors are coming in at all points of time. It's different to the trader who has developed his trading strategy, or the manager who has developed his trading strategy from inception to where it is currently. They recognise the features of that strategy. They've coded it, they've developed it, they're fully aware of the volatility that exists in it, and they've been in it from inception. However, investors come at, allocations into these programs come at all points in time. And what investors don't like is when they come into a highly volatile fund at the peak of that investment and they find that it immediately goes into a smashing drawdown, and they don't like that. That's understandable from an investor's perspective,
Yes.
but from the trader's perspective, who understands that system, that is a necessary pain you've got to go through to achieve what we want.
Yes, and I totally agree with that. I just thought that there is additional value for us to understand who actually those investors are. Who's demanding this. In my mind, only the people who are managing money on behalf of actually who own the money are trying to demand this management because they need to manage their career risk. So basically, on one hand, people are trying to hedge their career risk, so that's why they need this management, and that's how the how this thing works at the moment. When you say investors, because these same investors were around 30 years ago, but they were not demanding it. So something else might have shifted in the last 30 years for them to ask for it. And the career risk is the only explanation that comes to my mind, but maybe there are other reasons as well. Thank you.
I think we have to be a little bit careful here, just saying that it's only due to the business side of things that people use dynamic position sizing. I don't think that's true. First of all, some of the firms that actually started out using non-dynamically adjusted position sizes did that because technology didn't allow us to have dynamically adjusted positions back then. And during their journey, as part of the evolution, some of these firms have changed and are now using dynamically adjusted positions. And I don't believe we can say that that's just because they manage external money. Some, I would imagine, will have found that in their view, according to their research, this is a better approach. Even if you're just managing your own money, let's just say that Jerry found during his research that actually he didn't have as bad drawdowns as he has today, but he would make the same amount of money. Um, and there are many people, I think, who would then have to say, well, isn't that a better way to do it? It's hard to say, it's hard to dismiss it if your research shows that actually you can get the same returns, but with lower drawdowns and lower volatility. So I just think we have to be open to the fact that there may be some people who have found it to be a better way. It doesn't change the fact that the core concept of what we're doing is the same. I mean, I work, obviously, as everybody knows, I work for Don, and we've been in both camps. We started out with no dynamically adjusted positions, but we have dynamically adjusted positions for a long time now. And for us, I believe it is because our research people have found it to be a better solution than what we had before. Otherwise, we wouldn't have done it. Because it's clearly not because we are the largest $10 billion firm that requires us to do it. So I just want to caveat that and comment that I think that there can be more than just client wishes involved here.
I agree totally, and I've said it many times. More in a negative way that and it's not just the evidence and the back test; it is the philosophy. And maybe if you come from managed future from trend following, like Niels and I did in the '80s, and done before that, then morphing into that direction is one thing. And then if you come from not really a trend following first experience and mentors and you weren't brought up like that, then maybe you keep as much of the traditional um, money management ideas, and then you sort of add a bit of trend along the way. I've often kind of tongue in cheek made fun of that if I went up to people and said, "Hey, forget the vol management. I don't really care about volatility. I just want you to trade as large as you can and just make sure I get my capital back at the end of the day. So in 5 or 10 years, whoever gives me the most money back is the winner." I believe that most of these firms would say, no, 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 we can't do that. It has nothing to do with, it's not responsible. We don't believe that. You're asking me to change my worldview and things that are ingrained in me that I firmly believe. Hey, look, if Jerry believes in classic like he does, can I believe in what I do with that same intensity? Yes, and they do. And so it is really not just the back test and quote unquote evidence, because we're all saying we have evidence. It is, how were you raised? What is your experience? Morgan Housel did this. He does all these great papers um, and posts them on his website. And one recently was, how impacted we are with our experiences. And you're just not going to be able to change us. Human beings, a lot of the time, we cannot turn our back. It's hard to turn our back on our experiences.
That's a great point, Jerry. And just quickly, so we can, I don't know about you guys, but I certainly do a hell of a lot of back tests. And I know with my back tests, I can produce better back test results than what I'm achieving when I'm looking at the, on a gross performance basis, what the fund managers are doing. But I know that's a back test. That's not a live track record. So, and this is where the CTA replicators have come undone. When they're talking about research, they're talking about back tests. And when you're talking about back tests, it's always easy in hindsight to pull out more supportive information to make your models better. And that's an inherent process in back testing. It is overfitting using the back test. Now, what I'm saying is that the things that we're comparing against are those things with a live track record. That is not a back test. That is a live performance track record. They don't have the benefit of having the back test to create their live track record. They're living on the right-hand side of the chart. And when you do that, you don't have the benefit of that hindsight. And so that's where philosophy becomes more important than backtest. And that's where, when I look at these people that say, oh, I can generate a CTA replicator that can outperform these guys, I have a little laugh because I know they're going to come undone because they're using their research process or their backtest process to say, well, if the past is the same as the future going forward, we're going to clean up. That is not how the future unfolds. We move into an uncertain future. We don't know what it's going to deliver. You don't have the back test as your benchmark. You've only got it as a basis to test for robustness. That's as much information as you can get. And I think these discussions about which is better using a back test, that's a furphy because it's really what is your live track record saying to you?
I like all these ideas, and I think that we must understand the logic behind the system, as I always say. And also, for me personally, I must understand and think a lot of how many surprises can I face using a particular approach. How many surprises? And trend following is very adaptive for very different environments, and we have now a back test. We can see this. We can see this how adaptive it can be in very different stressful environments, and it's a very good sign for me personally.
And what we test is going to be influenced. I mean, even what we test, have you ever tested this? No, I haven't tested that. Why? I don't believe in that. I mean, so, it's like going up to an engineer and saying, have you ever tested what would happen in a big high rise if you didn't use steel? He's like, no, why would I test that? Well, I heard other people are testing it and they're coming to some new conclusions that you can build big high rises, with vastly different methods that you've used over the past 200 years of engineering, or even thousands of years going back to the Romans or whatever. And so some of these things, it's just, no, we haven't tested it. We're not going to test it. Our worldview precludes us from testing it. Although as a fun little concept to do battle with Rob, okay, I'll go out and test it. And so we can't even agree on what we should test. And it transcends the evidence. That's why evidence-based is such a kind of silly term, because we all have different worldviews. It's kind of like saying, why don't the Democrats just look at the Republicans' evidence? Well, vice versa, because it's not about so-called irrefutable evidence that everyone is going to agree with. Way to go, Seth. I'm sure that Niels, I think I'm going to blame you because I'm sure Niels is like, oh, shockers. Jerry and Rich can get to fall management very quickly here at the slightest little hint.
I'm still a little confused. So is everybody now conceding that you can increase the expectancy of any system by adding dynamic position sizing?
Well, like I said, I think it's you can definitely, on the back test, it will definitely come up. The computer will keep running and come up with the variables necessary to make the Sharpe ratio better. I think it's it's a little bit disingenuous, because I think to some degree, regardless of what evidence I would be shown, I could always just default right back to what Oleg is saying. That is, I don't agree with the integrity. The sample size. I don't agree with all these moving parts and variables. All you've done is come up with a good back test, and then they could say what Rich would say. Well, how about so and so's 30-year track record of not classic trend following, but with heavy doses at different periods of time of dynamic position sizing? And I'd say, yeah, well, whatever. I still don't like it. But more expectation per trade? No, it's less expectation per trade. The trade stats will get blown out as high as they possibly can be with one entry, one exit, and a stop loss. The trade stats, they cannot get bigger. The average win, average loss, average trade. And the reason, and that's what I consider the average trade, is the expectation per trade. And so that's what goes down with vol management. What goes up is efficiency, a higher Sharpe. And that's why if you use vol management, on average, all of the trades, not every trade, but if you look at all of the trades, you take smaller, your winners are smaller, but your drawdowns make up for it. I just have a hard time. No one has ever been able to answer to me, how does vol translate into increased risk of capital? So I don't think that it's possible to do that. So vol of open trades, and of course, then I could throw in, well, you're not doing the trade level correct. Then I really got them, because then I do my trade level correct, and I'm the best person on the planet at protecting capital, although I'm protecting a number that can be far below my max AUM, where the rest of the industry is defending max AUM. What's the drawdown from max AUM? That's a very tough game. And in order to do better at that game, you've got to interject things other than one entry, one exit, and a stop loss.
By the way, I want to say about the backtest that, as we were talking about backtest today, and good topic, that in a trend following, classical trend following strategy, we can do a very good backtest. And because it's clear, we see breakouts, we see where our enter, we see where our exit would be. We can see our risk management, so it's clear. And a lot of strategies don't have such an ability. So you can do a backtest, so you can think that you have done a very good backtest, very good performance, very good results for maybe 30 years, but it's incorrect because it's not clear. And for example, I do not understand how to do a backtest for global macro, for example. I don't really know this.
I'm seeing it, Seth, is this. I think that if we treat the history for the last 20 years of what the market has actually delivered to us, you will find that probably, yes, Rob's right. I think dynamic position sizing does work. But I think this is because of what Niels suggested, in that the edge that they're deriving through that method is relying on some of the extra secret sauce that lies in that 90% of trades, at the expense of some sacrifice made in the 10% of the outlier trades that have existed in that history. So when we say, we know with the benefit of hindsight what the last 20 years has delivered, and you'll be fully aware that from 2010 to about 2019, it was a very low volatility regime with the occasional 2014, 2000, there was one other period, there was the opportunities for trends, but most of that regime was unfavorable for outliers. It was a very regulated regime. So we know with the benefit of hindsight that if we applied a classic trend following backtest to that known history, we aren't going to get a very good result over that period of time because the outliers were not prevalent during that time. That is the benefit of hindsight. That is why I believe that David Harding, for instance, pulled the pin with Winton, because he thought trends were dead and he was prepared to entertain new methods because he didn't see the outliers that existed that was presented when Winton was first alive and doing very, very well over many, many decades. And he decided to pull a pin. That is a symptom associated with hindsight bias, with knowing what the past has given you. So what I'm saying is that if you wanted to test whether dynamic position sizing versus classic trend following works, you've got to be prepared to put simulated data to that backtest, which has a higher frequency of outliers in it. If you can create outliers, and these outliers are chaotic anomalies, if you can put more and more of these in there, then compare on that simulated data how the dynamic position sizing works against classic trend following. That's my argument. I'm saying that when we get into this chaotic region, information deficient region, there is very little that we can actually get extra secret source from. And that therefore means that if you want to do a strict comparison, we're saying don't rely on the back test because that just tells you what's known. We know that. That's hindsight. When you're trading that right-hand side of the chart into an uncertain future, you don't know what the future is going to bring. It could bring many, many more outliers. And I'm saying that, as the markets possibly go into more sort of chaotic regimes in the future, we are very well placed with our very simple classic trend following models to clean up in that environment. And I don't necessarily think that dynamic position sizing is the way to go into that possible chaotic environment.
I just want to comment directly on this. So a couple of things. Just back to Seth's original point, where when you say it like this, Seth, I think we all kind of talk about quote unquote vol management or dynamic position sizing as it's something that is easy to just switch on and off. And I think we have to start there because just like you can have a system consisting of one entry, one exit, one stop loss that is horrible, or you can have one that is great. It's all about how you design that system. And that's exactly the same with dynamic position sizing. You can add dynamic position sizing and lose your shirt, but you can also add dynamic position sizing and improve your strategy. It's all about how good your research team is at the end of the day. So to Richard's point, so we actually did what Richard suggested in the sense that we have a live track record back to the 70s. So we can see what our returns were not using dynamic position sizing. And we have then, of course, run our current models that uses dynamic position sizing back during the same period so that we could do a comparison that is fair. And I have to say that dynamic position sizing, even through the 70s and the 80s and the 90s, where there were lots of outliers, still beats it. It also beats it in the 2000s and 2010s, which you, according to Rich, and I agree, you would probably expect that. But of course, we don't know if the next 10 or 20 years will be more of that, all back to the 70s and the 80s and the 90s type environment. So we don't know which one to choose. But if you can at least prove to yourself that your modifications, and it doesn't have to be dynamic position sizing, could be any modification you do, if you can convince yourself through proper, rigorous research that what you've done is not just something that is better during a certain regime, but actually is better across many different regimes, etc., etc., then I think it is fair to say, or fair to believe that that's a better system, and you should go with that. I think that is a normal path of how research should be done and how it should be implemented. But it's not a simple, yeah, you just add something called vol management and then it's suddenly better. No, you can definitely get into trouble with that. It's all about what you put into your design of these things, and so it's not such a black and white discussion in my point of view, in my view.
And just to continue,
I agree with that, and it all, to some degree, it gets back to this. Unnecessarily and incorrectly, Rich and I were criticized by people on Twitter who were Rob fans and saying that, well, it doesn't matter what you say to Jerry, he's never going to agree with this evidence, which is preposterous, but that's the type of stuff we get. And the fact of the matter is, at the end of the day, it's not going to be, neither group is going to necessarily convert, because it's partly evidence and it's partly your own psychology and your own worldview of trading. So the answer is, okay, let's get it on. Let's see what happens in 10 or 20 or 50 years, who survives. And it's all about surviving. And I think that even if we're wrong, we're going to have bigger drawdowns. That's our downside. We have bigger drawdowns, and we'll learn at the end of our career or in the afterlife. You were wrong. You could have made life a lot easier and smoother if you would have used some of these other tactics. Okay, I'm wrong, but I think that if you're wrong about um, adding more and more ideas and variables and parameters, the downside can be worse than just you unnecessarily created pain for yourself.
Come back to Richard Jerry's point about can anybody tell me if there's a logical foundation to variable position, dynamic position sizing. And there is one, and it goes. And the reason why people keep talking about Sharpe ratio is not because we all of a sudden have become Sharpe ratio evangelists or newborn Sharpe ratios. It's just that if you improve your Sharpe ratio, by definition, you're cutting down on your risk of ruin. So that's the analogy. That's why looking at Sharpe ratio is important. And perhaps that's certainly in my case, that's the one of the main reasons to look at this type of position changing. And then I very much second Niels. Obviously, he's got a lot of experience and very good one to bring to the table. But you can't do it on a Tuesday and not on a Thursday, and then a little bit on Wednesday, just because you have to do it, in a certain and coherent way, applying a certain coherent way. But back to Jared's point, it's not that if you do this type of risk management overlay, you're going to readjust the portfolio every day, because you have to assume for some noise, background noise, and you don't want to fit to the noise. So you have to have a certain tolerance ratio or inertial ballast, however you want to call it. So everything can be reconciled. As Neil said, is not something that you can do on a whim, and you have to apply a little bit. But by the same at the same time, it's not something that is done continuously every time the market moves one tick. So perhaps this should help reconciling some of the differences. And then once again, I go back and then I stop. It's a fundamental design feature. You can't do a little bit of this and a little bit of that. And people have to pick sides, and it's really unfortunate that we're fighting because I think that it just takes away from the fact that actually trend following is about hunting outliers. It's just there are many different ways of hunting
I'm going to go
outliers.
back through this recording, Bruno, and I'm going to find who was the person who mentioned volatility targeting or dynamic position sizing to start. I mean, how dare they?
So, just one point. I think one of the things about, people give a lot of emphasis onto this wall management today, because on the classic trend following end, people are mainly using long-term models, and the drawdowns that, we were discussing on the previous session, Richard has mentioned the MAR ratio of 0.5. So this equates into a lot of drawdowns, actually. But on the moment that you trade a short-term model, okay, your drawdowns are much lower, especially if you are risking like a money manager, like a 20 basis points. Then your drawdowns, I would say, could be well less than 10% when you're trading with these hourly bars. And when you put this short-term trading into the equation going forward, with this technology and all, that we are all talking about, because the next 10, 20 years is going to be high technology intensive trading. I'm not quite sure whether there will be enough emphasis on wall manage or not wall manage, because from what I understand, from what Niels has mentioned, wall management was a necessary beast to take because they were mainly trading long-term models. But when you incorporate other things like short-term classic trend trading, I think the need to wall manage perhaps is going to be less there. At least this is my understanding of the situation. Thank you.
Bruno, I just wanted to get back to you and ask one question. Did you mention that you thought that a higher Sharpe ratio would reduce the risk of bigger drawdowns?
No, not bigger drawdowns, but risk of ruin, which is different, right?
Okay.
Higher Sharpe ratio shouldn't really affect the magnitude of drawdowns because it depends on these drawdowns depend on how fast you're trading more than how many wins you have in the portfolio. I mean, you can decide to have a very low win portfolio but win large, and therefore your drawdowns are going to be a little bit a little bit bigger in isolation. But if you are trading a lot faster, you're going to have strings of drawdowns, and then they might produce a deeper they can accumulate to a larger amount. But if you look at the probability of hitting your overall stop, i.e. Margin calls or losing too much, and then your investors pull out just pull all your money away and everything, the higher your Sharpe ratio, the lower this the probability of hitting your point of ruin is. And this is because if you think about it, the higher the Sharpe ratio, the more money you make per unit of volatility or risk. The problem is that, and we keep saying it, it's very difficult to forecast the returns, right? Almost impossible, very, very hard, very noisy. However, it's possible. It's easier, not easy, but easier to focus on the denominator of a Sharpe ratio, on your volatility, on your, if you wish, drawdown. So, the improving the Sharpe ratio leads to lower risk of ruin because you can better control your ability to either have less frequent drawdowns or less deep drawdowns, and therefore being stopped out. So that's what I meant.
I have a question for Richard. So Richard, you mentioned that because of the future is unpredictable, it's better to just focus on the 10% of the distribution and forget about the 90. But shouldn't the logical argument be quite the opposite, that a strategy that extracts, that vacuums profits from bigger part of the distribution, from the 90% and from the 10%, is more likely to survive and adapt to whichever the future brings, compared to a strategy that only focused to the 10% outliers?
Yeah, so the way I view that 10%, whilst we're talking about 10% and 90%, we're talking about frequency of the trade distribution. So we're not talking about the magnitude. So in that 10%, we've got the lion's share of the magnitude of price moves, as opposed to the 90% of much smaller price moves, up and down linear price moves. So I think that no matter, when we're looking at a complex adaptive system, inevitably all complex adaptive systems over a long-term distribution have a leptokurtic signature. They all have tail regions, and those tail regions, they tend to be, 5% or so of the total distribution combined. That's combining both left and right tails. Over long-term data sets of a complex adaptive system, you find that there is inevitably this uncertainty in those leptokurtic distributions. And if we exclude trading the 90%, so our method is a method of exclusion rather than a method of inclusion. And what I mean there is that we are not trading all the time. So we are not trading during all parts of the distribution. We are specifically trying to avoid the bulk of the distribution. We're only trying to therefore participate in the market when things start getting extreme. We know that these complex adaptive systems produce these tails. We know that the price move needs to be quite extreme before we activate our models, and therefore we are reducing, we're trading a far reduced sample set of outliers in the majority, as opposed to a much larger data set comprising both the bulk of the distribution and the tail. So this method of exclusion is, and through diversification, allows us to have these small tail components of each market, but widely distributed across a diversified portfolio. So we're working with a subset of what the market gives us, and we're looking at that subset that is dominated by, hopefully dominated by, outlier moves.
Okay, yes, I understand that. So, but you, I think yourself mentioned quite a good analogy that volatility, adaptation of volatility, actually, so these systems that adapt to volatility may actually derive 50% of their profits from the 90% of the distribution and 50% of the fat tails, whereas yours and the one that doesn't adjust to volatility or only focuses on the tails gets 100% of their profits from the 10% of volatility. So if that is correct, and I think that's close to the truth, these people who are actually doing similar things, they are extracting some profits from the tails, but they're also extracting profits from the other parts of the distribution. So to me, they seem more diversified to more outcomes, to more future outcomes than somebody who focuses on getting 100% of their profits from the 10% of the distribution.
That's a very good point, and I totally understand where you're coming from. I do agree with that, but I choose to inhabit this tail region because I think that what we've experienced in the last 30 years is a very small sample set of what the market can possibly deliver. And when I say that what the market can possibly deliver, I'm implying that I think there is far greater outlier potential in reality over a very long-term data set that we haven't seen than what has been presented by the last 20 or 30 years. So I think the market has been operating around equilibrium. I think it's been exhibiting extreme mean reversion, a lot of noise, but I think that what is possible with the market is far greater than what we are actually seeing with the historical distribution of market returns over a small sample over, say, the last 20, 30, 40 years.
Sorry, real quick, this is that philosophy conversation again. Kind of looking forward, as Richard is, a chaotic system, interactions are nonlinear, and he's implicitly proposing that the system is bound to be at least as chaotic as it has in the past, which means it's going to be characterized by these direct and indirect feedback loops. So more outliers to come. I tend to agree with that, with the way information is being kind of propagated through the system and increased kind of homogeneity in your average retail investor. It makes a lot of sense to sit in the tails, preserve capital. There's also just the simple logic of limiting your downside and cutting your losses short. I know Jerry likes to accentuate the loose pants and the open profits. To me, I like the cutting of the losses and that just systemically creating this positive skew in your return stream. You just have to be comfortable making money when nobody else is, and treading water when everyone else is got the wind at their back. So that's it for me.
Hey, good afternoon, everybody. Moritz here. I think Seth asked the question. What was the question, Seth? Can the expectancy, or is the expectancy higher of a trade or of a system if you have vol control or dynamic position sizing switched on or off? And I don't think you can answer that with a yes. I think that's a pretty much unanswerable question. If you wanted to answer that question, you would have to know for a long position if in the future there was going to be a negative correlation between price and volatility. So spot moves higher, volatility goes down, which forces a dynamic position sizing mechanism to increase the position size of that long position and therefore amplifies the P&L of that trade. You don't know that when you enter the trade. So I think the expectation is exactly the same. And for the short position, the reverse is true. You would need to find the market, and you would need to have to know today that whatever happens in the future while you have that short position on, there's going to be positive correlation between spot and volatility, such that if price goes down, volatility goes down as well, so that you would increase your position size of that short position. And then at some point comes the turning point where that position goes against you, and you will have a larger position at that point in time. You just don't know. It's impossible to forecast the volatility behavior of any of these markets from the time you enter them, from the time you enter the trade to the time of the turnaround of that trade where you still have the position on, up to the point where you exit. I think that's kind of like, it's not a good use of my time to think about this that way. What I haven't heard in this discussion, and I'd like to hear everybody's opinion on this, when I ran the numbers on my systems with, dynamic position sizing switched on or switched off, and I've run a couple of tests, such that it is a volatility cap, which means that I would only decrease positions but never increase, or would have a volatility target, which would change the positions in both directions. It doesn't really matter. But what I found is that, and this I think rhymes with the 90% of the distribution discussion that's going on. And I think that's true. You have that very leptokurtic middle where, most of the time in a very controlled statistical environment, you have clarity of sight, if you will, or, that's organized behavior and nothing too much of the wild stuff going on. Once you leave that area, you go into the both tails, that completely changes. You have absolutely no ability to fly on autopilot anymore. The markets just do what they want to do. In these tails, any of these volatility control mechanisms, because you don't know what's happening, you also don't know what, volatility control will be doing at that point in time, other than, for sure, increase your trading costs, increase your bid offer costs, and all this type of thing. That is something that you know for sure. There's a hurdle that it needs to overcome. But what I found, and maybe you should look at that, is most of the P&L, the additional P&L that would have come from a dynamically position size program, I find that to be in the bond markets, the short-term interest rate markets, and the equity markets, because there you have exactly what I've described. You had very long-term trends in the bond markets to the top side. We've all been long, and volatility in the bond markets kind of like went lower and lower and lower and lower because of central banks and all these type of things. Short-term interest rates, same thing, right? So you just made more money with that particular sector of our portfolio, and that has been quite a meaningful contribution. Equities, same thing, last 10 years. I think Niels was saying he could see improvements in even in the 80s, where maybe less of the financial markets existed, but more of the like commodities, natural gas, and crude and these type of things. I don't see this. I cannot get better returns on volatility, crazy. No, take that back. Just a market such as natural gas happens to have more volatility usually than other markets. I don't have better results with volatility control turned on. I just have more trading cost. And natural gas tends to be a market that, every once in a while likes to go into the tails, whereas other markets stay more in the center of the distribution. So I just encourage you, maybe share the results if you have them. Look at FX. But really for me, it's been, if you don't have the bond markets and the equity markets, it's just no point doing volatility control.
I would actually agree in terms of the trade. I wouldn't do on the short-term side with multiple entries and multiple exits on the same trend. So definitely the costs would make it unfeasible to trade it like that. Thank you.
I think I want to modify my question. Let's put it like this. If you're to look at the history of your trades without and with dynamic position sizing, are the outlier trades decreased in return to get more return from the bulk of the trades in the middle? Is there a way that you can dynamically position size where you increase expectancy of the outlier trades and the bulk of the distribution trades, or are you giving up outlier profits to gain profits in the middle of the distribution?
The latter, Seth. I believe it always comes to an allocation decision. So you can either be 100% invested in the tails, or you can be 80% invested in the tails with 20% invested elsewhere in the center of the distribution or the bulk of the distribution. So that's an allocation decision, and it's a blend. It's going to produce a smoother result, but I think it's a compromise, and I think that there is a cost, and particularly what Moritz said that was great on the trading costs. There is this inevitability of dynamic position sizing. We're introducing more trading costs, slippage, all of these things into your model. And that's an additional hurdle you've got to overcome. But, you know, when it comes to an allocation decision, I choose to invest 100% of my efforts in the tails. And, you know, today on Twitter, I did one of these other, you know, top 10 blends of 100% trend following. You know, this discussion where, you know, the key word these days tend to be return stacking, but it's certainly not something that, you know, that's something that a trend follower is fully aware of. They blend through their diversified portfolios is a form of return stacking effectively, or a blended portfolio. And when, for instance, I blend these top 10 trend following funds, I get this magnificent, smooth return stream that offers significant CAGR. Now, the reason for that smoothness is because the distribution has got the distribution of outliers within that distribution over that entire 20 years track record is widely distributed. A classic trend following program, unfortunately, doesn't get that degree of distribution of outliers. So their models tend to have less, you know, outliers are more sort of infrequently positioned within that return distribution. But when you get multiple different programs of multiple different models of trend following, you can obtain that distribution of outliers throughout the entire return stream. That is what's doing the heavy lifting of that entire equity curve. Even though you'll see it's a smooth one, it's the outliers that is actually lifting that entire equity curve. So that's my opinion.
Yeah, I agree. And I think that back to Moritz's point, I was totally focused on the back test. So yeah, what's going to happen in the future, I don't know. We don't know. However, I'm very intrigued by one thing, and that is I had just laid down the gauntlet that no one can or ever has convinced me that, or even proposed that somehow a vol management, volatility, and Sharpe translate into risk of capital. And then Bruno steps right up and does it. Very good. I love that. So anyways, my question to Bruno is, I think that's just the one thing I would just, if Bruno hadn't have said it, I would have just said no. Okay. However, I'm trying to figure out how Bruno and both of us can be right. And I would just try, I don't know the right question to ask. I think Bruno can figure out where I'm going here. And that is, can you see any way that that would possibly not be true or as true, that Sharpe does translate into risk of ruin, or risk of your defined ruin, if we used this trade level concept of not using total AUM all the time as kind of our trade level, but we use this number that was dramatically lower sometimes, most of the time, than total equity. Is that a way to get around? Can I be correct as well that it really doesn't translate into my volatility of these 100 to 500 ATR moves? I end up booking it at 200. The 300 ATR drawdown doesn't affect Jerry as much as it would more traditional approach to trade level.
Well, when I say that, Jerry, you're way smarter than anyone that understands and manages all these mathematical tricks and things, is because of that. I mean, you've just managed to blow apart this argument with your, I call it, accounting trick of having two equity accounts. Your two equity accounts just completely puts you in the right, boxes up the argument from a logical and from a real life, because obviously your track record speaks for itself. So you've done it. In terms of, that's why I would really love that Rob versus Jerry death match, because in the end your accounting trick does it. The problem is though, how many people can afford that in real life? And that's, I certainly can't. And therefore, I'm one of the great unwashed. And so I have to, live by the open equity. I have to live by day-to-day margining. I have to live by daily mark-to-market. But I do agree that if we could live in this world that you are, you manage to catapult yourself, you teleport yourself in, you win all arguments, and there's no debate.
That kind of makes my weekend. And so, yeah, I really appreciate that. So it is.
Can I also provide a response, Jerry?
Yeah, it is an accounting trick. However, if Richard and I would have kept our mouths shut and we would have never led on to this simple tactic and just said, hey, we just have these fancy algorithms that have figured out how to not only enter and exit and size the positions, but exactly how to move the equity around. It's very complex. And, I think we would be way ahead of the argument game. But I agree with you totally. I mean, you're asking, people think that buying highs, selling lows, letting profits turn into losses, it's so many things. And this is just the cherry on the top that is so unacceptable to most clients. And it is kind of a pretend world. And I've often said that, being in the Turtle program, not only was it just this incredible fortuitous event and you learned all of this stuff and you were given money to trade. We were down 50% after a few months and he gave us more money. So the pretend environment, the environment that doesn't exist anywhere else, was this client coming to us and saying, oh, you're doing the right thing, you're doing the right trades, here's more money. So we were contaminated from the very beginning.
So just a comment to both you, Jerry, and to Bruno. So in terms of the comment about sharp, Bruno, I mean, I don't know about, I've forgotten about all the math argument you gave, but I do want to say that some of the biggest blow-ups we've seen in the hedge fund industry have come from firms with a higher Sharpe ratio, right? So I just want to throw that in there, like long-term capital, et cetera, et cetera. And to Jerry, I just want to say that, I mean, what you and Richard is doing with the way you look at trade equity, I mean, you could say that that is your kind of vol management, because what it does is it manages the vol of your overall track record.
Niels, briefly on Sharpe, I think you're absolutely right, and that, not to be disingenuous about it, I don't believe that you can accurately forecast Sharpe. So your LTCM is a failure of not seeing the risk. You were trading second moment for fourth moment or for third moment, so volatility for skew. You were doing all sorts of poor management, risk management tricks in order to beef up your Sharpe. But if there was a way to scientifically and sustainably and in a very stable way increase your Sharpe, your risk of ruin would go down proportionally. I mean, this is just, it's Kelly criterions math. It's simple
Sure.
math.
Sure.
And that's
No,
the
I
problem.
think that's fair. That's fair.
That's a really good point, Bruno. And Kelly criterion, I know for stable distributions, it's the optimal method, or optimal F, or Kelly criterion. But we know in this real world that these distributions are not stable. So what it does is it maximizes or optimizes your bet size to that stable distribution. And when things get outside that threshold, boy, you're going to pay for it with the Kelly.
In essence, that's what drives, I think, a lot of our philosophy, is that if given a choice, I will take the more conservative route. Don't you trust the back test that you do yourself? Well, kind of, but I don't want to trust them too much. And if given a choice, I will take the bumpiness and that you get by fewer parameters, one entry, one exit, and a stop loss, and making less money possibly and having way worse of a time, but I'm just too conservative or afraid, or I just don't trust the future. I personally certainly don't trust the back test. That's why I only use the trade stats, and I never would use any sort of equity curve back test stats to make a decision on what I'm going to do in the future. I want to be way too conservative and more conservative than I probably need to be.
Maybe to throw in one other topic, Jerry, you mentioned Cliff Asness's article. There's one thing in it that kind of surprised me a little bit because he puts a lot of weight on what the mandate of managed futures is. And one of them, he says, is to generate good returns when equities are down. And I'm wondering how many of us have to put anything specifically into our models that says, oh, we have to make money when equities are down. And so it surprised me that he put that as a mandate of managed futures. I don't see any strong evidence that that's something we specifically target.
Well, the guy from Quest, he calls out CTAs for becoming too long term, including equities, not having more reliable crisis alpha, and it's definitely part of managed futures. I mean, I don't think I certainly can't put anything in my system um, to be more there for stock sell-offs without severely hurting my own performance. And one of the things, obviously, that I disagree with and I think he criticized people trading stocks, CTAs trading too many stocks. And so I totally reject that whole idea of managed futures in any way. I mean, if I happen to be by accident helping out my clients when stocks go down, that's great, but it's totally accidental. I mean, I'm trading a lot of different markets and I have on shorts and I'm shorting stocks. So it's likely I might be able to help, but I obviously reject Cliff and that entire idea that of any sort of crisis alpha. In fact, back in the day, 10 years ago, I got an email from Mike Dever, and the headline on the email, the subject was the perfect hedge. And I called him up, like, what are you doing? He goes, yeah, I know, that's stupid. I'm like, yeah, it's not the perfect hedge, it's the perfect portfolio. So CTAs have left a lot of AUM for others because people need trend following on their equities. Equities are a great diversifier. We need to trade these single markets, French fry stocks, uh, all kinds, lose my train of thought, all kinds of different stocks that are add diversification and that people dramatically need. There's no substitution when you have this dysfunctional portfolio of long stocks and bonds, and you're trying to add in 5 or 10% of an alternative. Why not just take 50 to 90% of your stocks and use trend following? I mean, that's what is needed. And so no one wants to do that. The downside is too large. We have our AUM coming in. Why upset the apple cart? So it's not going to be me, but someone will eventually get a hold of that and implement this perfect portfolio, um, and give people real crisis alpha that only comes from trend following.
Yeah, Jerry, and I also agree with Neil's comment that I don't agree with Cliff Asness's mandate for managed futures. I view managed futures. By the way, I've been in this business for 20 years institutionally. Now I'm running my own capital and some couple of family offices. My goal for futures and for trend following is to create a portfolio that will maximize my returns and minimize my drawdowns and volatility on this planet. That's the only thing. There's no philosophical marriage to a certain concept or marriage to fat tails or whatever. And I think that you're right. A lot of AUM has been denied the futures industry because of these faulty mandates of them being as a hedge to a stock and bond portfolio or whatever. And I claim that there is a way, instead of proposing to an investor, yeah, you have your 60-40 stocks and bonds, and then you maybe put 5 or 10 or 15 into CTA or managed futures, and you'll be fine. I think the way of the future is that where the managed futures will take over the stocks and bonds portfolio, manage them more intelligently, with stocks obviously with a long bias, because if you do a back test on stocks over 300 years, they just keep going up. So there's no reason to have a long and short symmetry with them. So by just applying certain logical, and you can use the stocks being long, like long-term holding stocks as a different factor, as a different strategy. And if you applied it to a managed futures portfolio in the equity asset side and to the bonds, I think it's not that complicated to marry trend following with long stocks and bonds and create a perfect portfolio, which I think will be much more attractive to an investor who can invest 100% of his capital in it, instead of advertising for 5 to 10%. So my goal for my portfolio is that I have built a portfolio in which I, as an investor, am comfortable putting all my money in. And I think this is the next wave for CTAs and for managed futures. And if that can be marketed, I think that will be the next wave.
Well, beautiful. I mean, of course, I agree. It's now there's 2 or 3 of us, but no, you're right. There was a friend of mine was on a video yesterday talking about, well, I only want to do things that are doable. There is this pie in the sky. There is these great ideas, but can they happen? Well, look, come on. Every great invention ever, any great breakthrough has been. They're usually things that no one could have even imagined could happen. So, is it likely that CTAs will, with their trend following, will trade the majority of the assets? No. I mean, it's not likely. Is it ever going to happen? Yeah, it's going to happen one of these days because it's the right thing, and the right thing will win out. 5 years or 50 years, who knows? So I'm not going to be afraid to advocate the best possible solution. At the same time, I'm under no illusion that everybody's going to go for it. But someone has to say the truth, and someone has to be out there advocating such stuff and understand, and not somebody can. They're in a situation where they can propose things that are laughable and unusual, but they're better in the long run.
Can I also add that along these lines and towards this goal, volatility management goes a long way, because volatility management, volatility normalization helps to merge more than one strategy. So if you normalize for volatility across instruments, across timeframes, and across strategies, if you see every time frame, strategy, and instrument as a pixel in a 3D cube, and that pixel you normalize for volatility, then you can treat every pixel in that huge cube as equal in terms of your volatility space. And then you can allocate volatility knowing that each pixel is an equal unit of volatility for you. And another argument towards volatility normalization and adaptivity is that if you don't normalize for volatility, you're basically saying, okay, I entered my trade. Now, 2-3 years later, I have this position that I entered 3 years ago, and I don't care how far it goes and how volatile it is. So you're throwing away a gift of data that the market has given you for 3 years. The market has given you data which you refuse to use, okay, for some reason. And I don't see a reason for that. Another way we already concluded that it's very hard to predict volatility. But just as there is a serial positive correlation in price, creating fatter tails, there is serial correlation in volatility. Past volatility does predict future volatilities to some extent. Refusing to use that data to improve your performance is unnecessary. I think the market has given you a gift of data. You're just closing your eyes and say, no, I don't need it. I just need my data from 3 years ago. I'm fine with it. I don't see a reason to just reject it on any basis. If you can use it, you should use it. And if you can predict volatility based on past volatility, you should do it. That's what I have to say.
Yeah, I'm pretty sure I'll need more time to think about that, and I probably don't agree with that. But given all what Bruno said, I'm definitely going to go back and listen to this recording many times. And I do want to make one comment. Niels was spot on, and that's a very good way of analyzing this idea that this way of having two equity curves and our trade level being close to our realized profit and loss is our way of controlling our volatility. Exactly, that's exactly what it is. And so why the difference? Because we think that the trade level calculation we use doesn't interject more variables, doesn't interject less robustness. It's safer. And for me, it allows me, not only do I use something other than a lower number than total AUM, but I don't change it very often. So I'm once again very focused on being able to treat maybe a year's worth of trades the exact same way. I mean, I'm happy when I make money, but I do have to figure out, okay, how am I going to change my trade level? When am I going to change it? By how much? And now the next group of year's trades are going to be handled slightly differently, same unit size, but a different trade level now, which is, not the end of the world, but it is something to manage for that you need to be careful about. Okay, with that said, I need to say goodbye and have a good weekend, everyone. And we'll pick it up
All right,
next
thank
Friday,
you.
same
Yeah.
time.
Take care, everyone. See you later.
Thank
Bye,
you.
everyone. Bye.